Canada, home of the polite maple syrup, beavers, and a controversial prime minister. For the last decade, Canada was mostly regarded as the warmest of its North American neighbors for its enviable healthcare system and openness to immigrants. However, this positive ensemble has been mired by controversy in recent years, like the truckers' strike and the dubious government policy regarding social media content and use. But all of these pale in comparison to the current state of the Canadian economy. So what's going on? And more importantly, how did we get here? Let's find out. A picture called Canada. Canada has quite an interesting geography, besides sharing the longest land border of any country with the United States. Around half of its populace lives south of said border. Even more mind-blowing is that a staggering 80% of the population lives within 100 miles of the US. That's about as close as neighbors get. Strange as that may sound, there's a reason for this. See, the most lucrative industries are in the southern provinces, whether that's real estate, manufacturing, or mining. For perspective, Ontario alone provides up to 38% of the Canadian GDP. That said, wherever thriving industries exist, people flock to them for the economic opportunities they provide, hence the population density. However, this density and high level of economic activities have come at a premium: housing prices. Add to that, the ripple effects of the 2007 housing market crash, and housing costs in Canada have more than doubled. What makes this an interesting case is that this surge in value is due to a boom in the Canadian housing market. I'll explain. Following the ripple effects of their American neighbors' market collapse, the Canadian government set up a stimulus program to help restart the economy. The country's central bank also set interest rates at nearly 1%, which encouraged Canadians to take on truckloads of debt and acquire homes for themselves. With such pleasant conditions, lots of Canadians jumped at the opportunity to own a home, either out of fear or hope that home values would continue to increase over time. A dismal present. Present-day Canada bears a sharp contrast to 2009 Canada. Interest rates are higher to manage lending and control housing prices. However, like any other remedy, side effects are present too. For most Canadian renters, owning a home is a fever dream. A poll conducted by Ipsos echoes similar sentiments, with about 63% of participants who don't currently own a home acknowledging that they have given up on ever becoming homeowners. But what is to blame? Well, the answer might draw a smirk to the face of the average conservative American: immigration. Canada, throwing its borders open to everyone who wanders in, has driven up rental demand significantly in the last few years. This much was acknowledged in a report by the Canada Mortgage and Housing Corporation. Most immigrants in the country initially opt to rent rather than buy outright, which helps in sustaining demand in the rental market. Although high demand often means an increment in rental prices, Canada isn't any different from any other first world country, like the UK and the US, which appear reasonably priced compared to the cost of owning a home. The only problem is that Canadian renters appear to be on the verge of a breaking point, especially as regards their ability to take on debt and spend money. Besides consumer spending power, another important metric to consider is consumer behavior. The housing market boom has changed how Canadians invest. The bulk of investment capital in the country goes to either housing or business. In this case, business investments represent non-residential structures, intellectual properties, and equipment and machinery. This lot only contributes to 9.3% of the country's GDP. Housing, on the other hand, gets the largest share of investment capital. This increased focus on the housing market drove up Canada's net stock of residential properties by up to 18.3%. Today, this sector accounts for around 22% of the national wealth. Put simply, most Canadians prefer to invest in the housing market than in businesses. Given the favorable rental market due to the influx of immigrants, investing in housing sounds like a great deal. However, you cannot forget that such a one-sided investment strategy is bound to have drawbacks. And it does, because as housing starts to dominate as an asset class, less attention and capital go into local investments, which means fewer jobs are created for the otherwise surging population. A ticking time bomb? Business investments are essential components for economic growth and expansion. It improves the overall productive capacity of a country through a larger physical capital stock, which means more goods and services are produced without a change in how much labor and additional resources are required. Canada's business investments pale in comparison to its southern neighbors, which is why it only accounts for such a miserly fraction of its GDP. The numbers don't get more promising when you place it under the microscope either. For perspective, business investments come from two primary sources: local and foreign investors. Despite how low local business investments are, the bulk of it comes from foreign individuals, usually US investors. That means the number of Canadian investors in the country's local economy is even lower than the overall figure suggests. Taking a broader view of the Canadian business landscape, everything starts to make a little more sense. For one, Canadian enterprises are rarely ever pioneers, nor do they dazzle in any way. A survey of 900 executives revealed that Canadians show a lot more aversion to risk than their southern neighbors. To further show how Canada flatters to deceive, 6 of 10 on Fortune's list of the biggest companies by revenue size are either American or Chinese owned, with the closest biggest Canadian company, Brookfield Asset Management, coming in at 158th place on the list. This level of performance is problematic, largely because Canada and the United States currently share a strained relationship. This isn't helped by the fact that some of the things that make Canada's economy unique are easily influenced by the US. Of course, this is no fault of the United States. In fact, the only country to blame is Canada, seeing as its economic policies and practices are developed based on the country's proximity to the US. For example, American companies flock to Canada to avoid high tax and tariff rates in the US. However, despite enjoying Canadian tax benefits, these companies tend to keep their intellectual properties and headquarters in the US. By comparison, Canadian startups are treated differently. The moment they go public by offering shares for sale, the company loses its tax privileges. It comes as no surprise why foreign companies and investors often swoop down on innovative and exciting startups in Canada. They are left vulnerable by tax policies that force them to stay private or endure harsher taxation, so selling seems like the best way out. Unsurprisingly, these events have left Canada's economy underperforming compared to the US in terms of innovation and productivity. For perspective, the average annual earning in Canada is $60,000 compared to $80,000 in the US. That is, Canadians only have to travel a few hundred miles south to experience a 33% surge in their average income and earning potential. Although, it's worth mentioning that Canadians work around 3.5 hours less than Americans. Not that that negates the difference in earning potential across both countries. In fact, on average, Americans produce more value per hour than Canadians. The average American worker produces $74 worth of value in an hour compared to the $57 produced by Canadians, a widening gap. What's to blame for the earning and value production gap between Americans and Canadians? The main culprit here is capital intensity, which refers to the amount invested in people, machines, innovation, and tools. From the trends discussed so far, it's pretty obvious that Americans outspend Canadians in this regard as well. While Canadians invest around $13,000 on capital intensity per worker, their southern neighbors invest up to $20,500. Also, of all the G7 countries, Canada spent the least on research and development. Add to that the report by the World Intellectual Property Organization, which revealed that the US produces roughly double the amount of patents per person than Canada. It seems like I've spent the better part of this video fixating on why Canada sucks compared to the US. But that's hardly the case. All of these figures and factoids tell a story about Canada's economy and how it affects the people living within its borders. For example, the productivity rate and growth are important factors that contribute to the standard of living in a country. Since Canada has been performing poorly in that regard, the income of the average Canadian in 2022 was around $57,800. Keep in mind that this figure has been adjusted for purchasing power parity, yet it falls an eye-watering $17,400 lower than its American counterpart. These chinks in Canada's armor haven't been glaring for many years because Canadians living in the bottom half of the income bracket were still financially well off compared to their American counterparts. However, that isn't due to economic policies, as it is more about Canada's lower income inequality levels compared to the US. However, despite having a better spread of wealth across the nation, Canada isn't doing any better than its economic dominant neighbor. In fact, of the developed economies of the world, Canada's is only averagely competitive. According to the IMD World Competitiveness Ranking, Canada sits 14th on the list of 63 countries. Although 1463 sounds pretty impressive, this is a historic low for the country and is the lowest it's dropped since entering the rankings in 1997. More aggressive free markets are currently dominating the rankings ahead of Canada, with the US sitting in 10th, Singapore in 3rd, and EU countries like Sweden, Norway, Denmark, and the Netherlands also putting in strong performances thanks to their high wages and strong labor protection policies. Understand that this index isn't a measure of how competitive an economy is, but rather its productivity levels. And given that some decade or more ago, Canada was one of the high flyers despite stiff competition from richer and larger economies, it's quite obvious how far behind the country's economy has fallen. A reason to hope? Does it mean it's all doom and gloom for Canada from here on out? Hardly. The country still has a lot at its disposal to turn things around and be competitive and innovative again. For example, the IMD ranks Canada 11th for its talent pool, showing that Canada has the brains to get things done. However, the country can barely compete for its crop of talent, who are easily poached by their southern neighbors with the promise of better pay. Canada must also be willing to rethink its over-reliance on its natural resources and housing markets and branch out into other equally lucrative industries, such as manufacturing, research, and entrepreneurial activities.